There is a test, a simple question that separates the fortunes of the few from the fleeting hopes of the many. It's not a question you'll find in a business school textbook, nor is it a complex algorithm run on a supercomputer. It's a question that looks backward to see forward, a question that finds its power not in predicting the future, but in recognizing the deep, unshakable inertia of the past. This question is the bedrock of a $90 billion fortune, and it is the final promise that enduring wealth makes to those who are patient enough to listen. It asks, what has this business looked like for the last 20, 50, or even 100 years? And from that answer, it builds a bridge to the next 20. For in the world of high-stakes capital allocation, the most profitable secret is that the future, for a very select group of businesses, is almost indistinguishable from the past. This is the principle of predictability, the rearview mirror test that Warren Buffett has used to sidestep the graveyards of innovation and build an empire on the solid ground of what is and what will continue to be. We are taught to chase the new, to seek out disruption, to find the next paradigm shift. But this approach is a siren song, luring countless investors onto the rocks of speculation and permanent capital loss. The true path to financial freedom, the one paved with the bricks of certainty and compounding, is found in the opposite direction. It's found in the boring, the mundane, the businesses that sell the same thing, day after day, decade after decade. This is not just an investment strategy. It is a fundamental rewiring of how you perceive risk and opportunity. It is a commitment to capital preservation over speculative gambles. Today we will deconstruct this billionaire test. We will dismantle its components, explore the psychological traps it helps you avoid, and provide you with a practical blueprint to apply it to your own financial life. You will learn to value the unchanging, to find immense power in the predictable, and to build a portfolio that is not just designed to grow, but engineered to last. The first pillar of this entire philosophy, the very foundation upon which all other decisions rest, is the profound and often underestimated power of predictability itself. It's the simple idea that the best business to own is one whose future earnings can be forecast with a reasonably high degree of certainty. This isn't about having a crystal ball, it's about finding a game so simple, so stable, that you don't need one. It's an intellectual anchor in a sea of market volatility, a commitment to understanding the essence of a business so thoroughly that its forward path becomes, if not a straight line, then a clearly defined and understandable channel. The ultimate goal of this pillar is to shift your focus from what could this company become to what is this company certain to be. To truly grasp this concept, we must travel back to 1972. Warren Buffett and his partner Charlie Munger, operating through their controlled entity, Blue Chip Stamps, were presented with an opportunity. It wasn't a revolutionary technology company or a groundbreaking pharmaceutical firm. It was See's Candies, a family-owned chocolatier that had been operating on the West Coast since 1921. For over 50 years, See's had been doing one thing: making and selling high-quality, old-fashioned candy. Their stores were a nostalgic trip, their recipes unchanged, their brand a beloved institution for generations of families. The asking price was $30 million, a figure that Buffett initially balked at. The company was earning about $2 million after tax, and the price represented a significant premium over its tangible assets, its book value. Buffett, still heavily influenced by his mentor Ben Graham's cigar butt approach of buying statistically cheap, often mediocre companies, saw the price as too high. He was focused on the numbers on the page, the physical assets he could count. But Charlie Munger saw something else. He saw an intangible asset of immense value, a half-century of predictability. He saw a brand that was so entrenched in the minds and hearts of its customers that it commanded a unique form of pricing power. He famously told Buffett, "You have to be willing to pay more for a great business." After some negotiation, they acquired See's for $25 million. At the time, it was the largest acquisition they had ever made, What followed is a masterclass in the financial power of a predictable business. See's candies required very little in the way of new capital investment. The recipes didn't need updating. The core product was timeless. Yet year after year, they could raise their prices just a little bit without any significant loss of customers. People bought See's for Christmas, for Valentine's Day, for birthdays, not because it was the cheapest candy, but because it was See's. It was a tradition. This small, incremental pricing power, applied to a stable and predictable sales volume, became a gusher of cash. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital to produce. This cash was then funneled out of See's and used by Buffett to acquire other businesses. See's candies became the prototype, the foundational anecdote for a new chapter in Buffett's investment strategy. It taught him that the most valuable asset a company can have is not a factory or a patent, but a durable, predictable stream of earnings power rooted in the psychology of its customers. The past of See's Candies, selling quality chocolate from clean, friendly stores, was the secret to its future. Nothing needed to change. And in that lack of change, in that profound predictability, lay a financial dynamo of almost unimaginable proportions. This investment, which seemed expensive in 1972, became one of the cornerstones of the Berkshire Hathaway empire, proving that boring could be breathtakingly beautiful on a balance sheet. It was a lesson in paying for quality, and the highest form of quality he learned was the certainty that the business would be doing the same wonderful thing a decade later. The reason Buffett's focus on predictability works so consistently is that it serves as a powerful antidote to some of the most destructive cognitive biases hardwired into the human brain. The underlying psychological principle at play here is the exploitation of what is known as status quo bias, amplified by the endowment effect. Status quo bias is our innate preference for the current state of affairs. Any change from that baseline is perceived as a loss. We see this in our own lives. People are often resistant to changing their bank, their mobile provider, or even the layout of their favorite supermarket, even if a better alternative exists. The effort and uncertainty of change create a psychological barrier. A business like See's Candies doesn't just sell a product, it sells the comfort of the status quo. The customer isn't just buying chocolate, they are buying the reliability of a memory, the certainty that the box of candy they give their mother this Christmas will be the same as the one she received 10 years ago. This desire for consistency creates a powerful moat around the business. Competitors can't easily break in by offering a slightly cheaper or different product because the customer isn't looking for different. They are looking for the same. The endowment effect compounds this. This bias describes our tendency to overvalue things simply because we own them or have a history with them. For a See's customer, it's their candy store. The brand is part of their personal history, their family traditions. This sense of ownership, this emotional endowment, makes them far less price-sensitive and far more loyal than a purely rational economic actor would be. Buffett understood, perhaps intuitively at first and then explicitly, that a business built on these psychological anchors is profoundly resilient. Its demand curve is not a fragile thing, easily disrupted by market shifts. It is a thick cable, woven from the strands of nostalgia, habit, and the deep human craving for comfort and certainty in an uncertain world. By investing in such a business, you are not just buying assets and cash flows, you are buying a stake in a deeply ingrained psychological pattern. You are aligning your capital with the powerful human resistance to change, which is a far more reliable force than the fleeting promise of innovation. So how can an ordinary person, an entrepreneur or an investor, translate this powerful principle into a concrete, actionable plan? The applied mental model can be called the blueprint of boring, a step-by-step process for filtering businesses through this lens of predictability. Step 1 is the grandma test. Can you explain what this business does, how it makes money, to your grandmother in a single simple sentence and have her understand it completely? They sell sugar water, for Coca-Cola. They sell candy for See's. They insure cars for Geico. If a business requires a complex explanation involving synergy, blockchain, or proprietary algorithms, it fails the first step. Simplicity and predictability are deeply intertwined. A simple business model is one that is less likely to be blindsided by unforeseen complexities. Step 2 is the decade rewind. Go to the company's investor relations website and pull up an annual report from 10 or, even better, 15 years ago. Read the chairman's letter. Look at the description of the business segments. Is the core business fundamentally the same today as it was then? Has the way it makes money changed dramatically? For a company like Wrigley's Chewing Gum or Hershey's Chocolate, the report from 2005 would look remarkably similar to the one from 2025. This historical consistency is your most reliable indicator of future stability. If the company has reinvented itself 3 times in the last decade, it is, by definition, unpredictable. Step 3 is to ask the product immortality question. Will people be using this product or service in 20, 30, or even 50 years largely unchanged? Will people still be drinking beer and soda? Will they still need to shave? Will they still be buying insurance for their homes and cars? Will businesses still need to transport goods across the country? These are fundamental needs and habits. A business that serves them is tapping into a current of human behavior that runs far deeper than any single technological cycle. This is a crucial part of any long-term investing strategy. Step 4 is the CEO insignificance litmus test. If the current visionary CEO were to retire tomorrow and be replaced by a reasonably competent but uninspired manager, would the business continue to thrive? If the answer is yes, you have found a truly great business. It means the system itself, the brand, the market position, the distribution network, is the source of the success, not the fleeting genius of a single individual. A business that depends on a charismatic leader for its survival is inherently fragile and, therefore, unpredictable. Applying this 4-step blueprint forces you to prioritize the structural advantages of a business over the fleeting narrative of the moment, guiding you toward the kind of stable enterprises that form the bedrock of true wealth management. Now let's explore the opposite path, the antithesis, which is the path walked by 99% of market participants. This is the path of chasing the next big thing. It is a world fueled by hype, narrative, and the desperate fear of missing out. Instead of the grandma test, these individuals are drawn to complexity, believing that a business they don't understand must be more sophisticated and therefore have more potential. They are seduced by jargon and futuristic promises. Instead of the decade rewind, they are focused entirely on the next quarter's announcement. Their time frame is measured in days and weeks, not years and decades. They have no interest in a company's past, only in the speculative promise of its future. They are not investing, they are gambling on prophecy. The dot-com bubble of the late 1990s is the quintessential example of this mass delusion. Companies with no earnings, no profits, and often no viable business model were being valued at billions of dollars. Names like Pets.com, Webvan, and eToys became household names, their stocks soaring to astronomical heights. Investors weren't buying a piece of a predictable earnings stream. They were buying a lottery ticket, a story about how the internet would change everything. They ignored the fundamental questions. How does this business make money? Does it have a sustainable competitive advantage? Is there a history of profitable operations? The answer to all of these was often no, but it didn't matter. The narrative was too compelling. The antithesis of buying See's candies for its half-century of stable profit was buying a company that sold pet food online at a loss, simply because it had .com in its name. The consequences were catastrophic. When the bubble burst, trillions of dollars of speculative wealth vanished. These companies, built on hope instead of history, went bankrupt, their stocks becoming worthless. This is the path of the 99%, a constant, frantic search for the new, leading to a cycle of boom and bust, of thrilling gains followed by devastating losses. It's a rejection of the slow, steady, and certain power of compounding in favor of a high-stakes, high-stress casino. It is the absolute enemy of capital preservation and the surest route to financial disappointment. Finally, we must trace this principle of predictability directly to the cold, hard numbers on a financial statement. How does this way of thinking translate into a tangible, massive financial advantage? The connection is through the concept of owner earnings and the reliability of a discounted cash flow, or DCF, valuation. A DCF analysis is a method of valuing a company by forecasting its future cash flows and discounting them back to the present day. The entire exercise is only as good as the reliability of your forecasts. For a young, unproven technology company, forecasting cash flows 10 years into the future is an act of pure fantasy. The range of possible outcomes is enormous, from wild success to total bankruptcy. The uncertainty is so high that any valuation derived from the process is practically meaningless. This is where a predictable business holds an almost unfair advantage. For a company like Coca-Cola or Johnson & Johnson, you can look at the past 20 years of financial data. You can see the stability of their profit margins, the steady growth in their revenues, the consistency of their cash generation. Forecasting their future cash flows is no longer a wild guess. It's a reasonable extrapolation. The uncertainty variable in your valuation model shrinks dramatically. You can say with a much higher degree of confidence what the business is likely to earn over the next decade. This certainty allows you to calculate a reliable intrinsic value for the business. Investing then becomes a simple matter of waiting until the market, in one of its periodic fits of fear or panic, offers you the chance to buy that predictable stream of cash flows at a significant discount to its true worth. This is the very essence of value investing. The direct financial connection is this: predictability dramatically reduces the risk of overpaying. It transforms stock picking from a speculative art into a disciplined science of valuation. On a portfolio level, this translates into lower volatility, fewer catastrophic losses, and a smoother, more reliable upward trajectory of wealth. It is the engine of capital preservation. The financial stability of the underlying businesses creates financial stability for the portfolio owner, allowing the magic of compounding to work its wonders, uninterrupted by the speculative busts that plague those who chase the unpredictable. The second pillar in building a portfolio engineered to last is drawing a sharp, clear line around what you understand and what you do not. This is the concept of the circle of competence. It's a principle that flows directly from the foundation of predictability. After all, you cannot possibly determine if a business is predictable if you do not fundamentally understand the industry in which it operates, the threats it faces, and the dynamics that drive its success. The circle of competence is not about being a genius. It is about having the intellectual humility to know the precise boundaries of your own knowledge. It's about recognizing that financial success is not found in knowing everything, but in knowing a few things exceptionally well and sticking to them religiously. Buffett himself has said that the size of this circle is not important. Knowing its boundaries, however, is vital. This pillar protects you from the greatest danger in investing, the unknown unknowns, the risks you don't even know you're taking, because you are operating in an area where you lack true expertise. The most powerful foundational anecdote for the circle of competence is not a story of a brilliant investment, but of a disciplined refusal to invest. It is the story of Warren Buffett during the height of the dot-com mania in the late 1990s. At the time, he was being publicly ridiculed. Magazine covers declared him a relic, a dinosaur whose folksy, old-world approach to investing was no longer relevant in the new economy. Tech stocks were doubling, tripling, and quadrupling in value. Companies like Microsoft, Intel, and Cisco were the darlings of Wall Street, and Buffett owned none of them. What makes this story so powerful is that Buffett was not ignorant of technology. He was close friends with Bill Gates, founder of Microsoft, and they spoke regularly. He had been tutored by Andy Grove, the legendary CEO of Intel, He had direct access to the two most brilliant minds in the industry, yet he still refused to invest. When asked why, his answer was simple and profound. It was outside his circle of competence. He explained that while he admired these companies and their leaders immensely, he could not, with any degree of certainty, picture what the competitive landscape of the technology industry would look like in 10 or 20 years. He couldn't predict who the winners would be. He didn't have a durable mental model for how their competitive advantages would be sustained against the onslaught of relentless innovation. He could see their success in the present, but he could not see their predictability in the future. Contrast this with his investment in the Washington Post company. Buffett had delivered papers as a boy. He understood the economics of a dominant local newspaper inside and out. He understood the subscription model, the advertising revenue, the brand loyalty, and the near-monopoly status a leading paper held in its community. He understood its economic moat. It was a business he could analyze, value, and hold with deep conviction because it fell squarely within his circle. While the world chased tech stocks he didn't understand, he was buying what he knew. The aftermath is history. When the tech bubble burst in 2000, Berkshire Hathaway, with its portfolio of boring insurance, consumer goods, and media companies, looked like an ark of safety. His discipline had not just preserved capital, it had put him in a position to deploy it at bargain prices when the panic subsided. This refusal to stray from his circle, even under immense social pressure and the temptation of easy gains, is one of the most important Warren Buffett secrets. It is a testament to the idea that risk management begins not with complex hedging strategies, but with a simple, honest self-assessment of what you truly know. The psychological principle underpinning the circle of competence is a direct countermeasure to the Dunning-Kruger effect and the overconfidence bias. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their ability. In investing, this manifests as the novice investor who, after a few lucky trades in a bull market, believes they have a special talent for stock picking. They mistake luck for skill. Overconfidence bias is the tendency for people to be more confident in their own abilities than is objectively reasonable. This is rampant in fields that involve prediction, such as finance and executive decision-making. People believe they can forecast the economy, predict interest rates, or identify the next revolutionary technology far better than they actually can. The circle of competence is an act of supreme intellectual honesty designed to defeat these two biases. It forces you to replace arrogance with humility. It demands that you acknowledge the vastness of what you don't know. Buffett's genius is not that he knows more than everyone else. It's that he is acutely aware of what he doesn't know. When he says he doesn't understand the long-term economics of a semiconductor company, he is not being falsely modest. He is drawing a clear, rational boundary. The average investor, caught up in the Dunning-Kruger effect, reads a few articles online, watches a segment on a financial news channel, and feels equipped to make a multi-thousand-dollar bet on a complex biotechnology firm. They are operating under the illusion of knowledge. By consciously defining your circle, you are building a psychological defense system. You are pre-committing to not let your ego or the siren song of a hot trend lure you into a game where you are the patsy at the table. It is a mental discipline that keeps you from becoming your own worst enemy, which is the ultimate form of portfolio protection. To make this concept practical, you can implement an applied mental model called the 3 Circles of Knowledge Blueprint. This is a personal exercise in intellectual cartography. First, take out a blank sheet of paper and draw 3 large concentric circles. Label the innermost circle Mastery. This is for industries or businesses you understand with deep, intimate fluency. You know the key players, the business models, the competitive dynamics, and the historical context. For a career banker, this might be the banking industry. For a lifelong software engineer, it might be enterprise software. Be brutally honest. This circle is likely to be very small, perhaps containing only 1 or 2 industries. The second middle circle is labeled familiarity. These are industries you know something about but are not an expert in. You might understand the consumer-facing side of the business, but not the intricacies of its supply chain or regulatory environment. You can follow the news, but you can't read the financial statements and see the story behind the numbers. The outermost circle is labeled ignorance. This contains everything else. For most of us, this will include things like biotech, mining exploration, and complex derivatives. The rule of this blueprint is elegantly simple. You are only allowed to invest in companies that fall within the innermost circle, the mastery circle. The goal is not to have the biggest circle, but to have the most clearly defined one. How do you expand your circle of mastery? Not by casually reading headlines. You do it by picking one industry from your familiarity circle and dedicating yourself to studying it for months or even years. Read books on its history. Read the annual reports of the top 5 companies in the sector, going back a decade. Listen to their investor calls. Build a detailed model of how they make money. Only through this deep, focused work can you responsibly move an industry into your inner circle. This blueprint transforms the abstract idea of a circle of competence into a tangible, visual tool for risk management and disciplined investment strategy. The antithesis to this disciplined approach is the expert in everything persona, the path of the 99%. This is the individual who has an opinion on every stock, every sector, every macroeconomic trend. They watch the financial news and feel qualified to jump from an oil trade one day to a cryptocurrency investment the next, and a pharmaceutical stock the day after. Their portfolio is not a curated collection of well-understood businesses. It is a chaotic grab bag of the week's most popular narratives. They suffer from what might be called information sickness. They consume vast quantities of financial media, mistaking the constant flow of information for the accumulation of true knowledge. They know the price of everything and the value of nothing. This approach is doomed to failure because it is built on a foundation of intellectual sand. Without a deep understanding of any single business, the investor is entirely dependent on the opinions of others, pundits, analysts, social media influencers. They are constantly reacting, never acting from a position of personal conviction. When one of their holdings inevitably falls in price, they have no framework to decide whether to buy more, sell, or hold. They don't understand the underlying business, so they can only react to the stock price's movement, typically leading them to buy high in a state of greed and sell low in a state of panic. This jack-of-all-trades, master-of-none approach leads to a portfolio that is perpetually churned, racking up transaction costs and taxes, and never allowing any single great idea the time to compound into true wealth. It's an exhausting, unprofitable, and ultimately confidence-destroying way to manage capital, a direct result of ignoring the simple but powerful wisdom of staying within your own well-defined circle of competence. The direct financial connection between the circle of competence and your bottom line is profound and can be summarized in one critical phrase: the reduction of unforced errors. In investing, as in tennis, the winner is often the player who simply makes fewer mistakes. Straying outside your circle is the primary cause of catastrophic investment errors, the kind of mistakes that result in a 50%, 80%, or even 100% loss of capital. When you invest in a business you don't understand, you are unable to properly assess the full spectrum of risks. You might buy a seemingly cheap airline stock without understanding its crippling sensitivity to fuel prices and labor disputes. You might invest in a retailer without appreciating the threat posed by a new e-commerce model. These are the unknown unknowns that can destroy a thesis. By staying within your circle, you dramatically reduce the probability of being blindsided. You know the right questions to ask, you know what the key performance indicators are, and you have a much better sense of what a realistic range of outcomes looks like. This translates directly to your portfolio's performance. A portfolio composed of 10 well-understood businesses is infinitely safer than one composed of 50 businesses you barely know. This discipline provides the ultimate form of portfolio protection because it minimizes the chance of a zero, an investment that goes bankrupt. As we've discussed, the mathematics of compounding are unforgiving. A single large loss does immense damage to your long-term returns. Staying within your circle is the most effective form of capital preservation. because it is the ultimate form of risk management. It ensures that the risks you take are calculated, understood, and intelligently compensated, which is the hallmark of a professional approach to long-term investing. The third pillar is the mechanism that gives a predictable business its durability. It is the concept of the economic moat. If a predictable past is the indicator of a stable business, the economic moat is the structural reason for that stability. An economic moat is a sustainable competitive advantage that allows a company to protect its long-term profits and market share from attacking competitors. Just as a medieval castle used a moat filled with water to fend off invaders, a great business uses its economic moat to protect its profitability. A business with a wide and deep moat can earn high returns on capital for many years, making it a wonderful long-term investment. A business with no moat is constantly fighting for its life in a brutal sea of competition. Understanding and identifying these moats is a critical step in Buffett's process. It's the bridge between finding a company with a stable history and having confidence that this stability will persist long into the future. It answers the question, why has this business been so successful for so long, and why will it continue to be? The foundational anecdote that perfectly illustrates the power of an economic moat is Buffett's investment in American Express during the Salad Oil scandal of 1963. This story is a masterclass in looking past a short-term crisis to see the indestructible competitive advantage underneath. A company called Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, defaulted on a massive set of loans. The scandal erupted when it was discovered that the collateral for these loans, enormous tanks supposedly filled with salad oil, was mostly water. Allied went bankrupt, and American Express was on the hook for potentially catastrophic losses. Wall Street panicked. The consensus was that American Express, a company built on trust, would be ruined. Its stock price was cut in half, plunging from over $60 to $35. This is where Buffett's analytical process diverged from the herd's emotional reaction. Instead of just reading the terrifying headlines, he went out to do his own primary research. He visited restaurants and banks. He talked to merchants who accepted American Express cards and travelers' checks. He wanted to know if the scandal had damaged the core business. What he discovered was that the moat was completely intact. Customers were still using their American Express cards. Travelers were still buying travelers' checks with unquestioning faith. The scandal was confined to a small, non-core division of the company. The main business, the powerful franchise built on the trust of consumers and merchants, was unharmed. He realized that the American Express brand and the payment network it represented was an immense intangible asset, a deep economic moat. People were not going to switch to a different traveler's check to save a few pennies. They trusted the American Express name. This brand power gave the company pricing power and customer loyalty that the market, in its panic, was completely ignoring. Seeing this indestructible moat, Buffett invested 40% of his investment partnership's capital into American Express stock. It was a massive, concentrated bet. Over the next few years, as the market realized the scandal was a temporary setback and not a mortal wound, the stock price soared, and Buffett's partners reaped an enormous profit. The story demonstrates that the true value of a business lies in the durability of its competitive advantage, and that market panic can create incredible opportunities for the rational investor who focuses on the moat, not the mood. The psychological principle at the heart of moat analysis is the ability to resist social proof and herd mentality. Social proof is the tendency to assume that the actions of others reflect the correct behavior for a given situation. When we see everyone selling a stock, our instinct is to believe they must know something we don't, and we feel an intense pressure to sell as well. Herd mentality is this principle scaled up to a market level, creating bubbles and crashes. In the salad oil scandal, the herd was stampeding for the exits. The social proof was overwhelming. American Express was toxic. Buffett's ability to resist this psychological tide was rooted in his analytical framework. He replaced the social cue, everyone is selling, with an empirical question. Is the core business being affected? He trusted his own research and his own understanding of the business more than he trusted the collective judgment of the market. This is an incredibly difficult thing to do. The fear of being wrong while everyone else is right is a powerful deterrent. To be a successful long-term investor, you must cultivate the mental fortitude to stand apart from the crowd. You must have a rational framework for valuing businesses based on their competitive advantages that is strong enough to serve as an anchor in a storm of market emotion. By focusing on the moat, you are focusing on the long-term business reality, not the short-term stock market narrative. This allows you to see fear not as a signal to flee, but as a potential opportunity to buy a wonderful moated business at a fraction of its true worth. It is a mindset that turns one of the most powerful and destructive cognitive biases, herd behavior, into a source of potential profit. So how do you systematically identify these economic moats? You can use an applied mental model known as the Moat Identification Blueprint, which categorizes moats into 5 primary sources. Before making any investment, you should be able to clearly identify and articulate which, if any, of these moats the business possesses. First, intangible assets. This includes brands, patents, and regulatory licenses. A brand like Coca-Cola's creates a mental monopoly in the consumer's mind. A patent gives a pharmaceutical company a legal monopoly on a drug for a period of years. A government license to operate as a utility creates a legal barrier to entry. Second, switching costs. These are the costs or hassles a customer would incur to switch from one provider to another. Think about your bank. Moving all your direct deposits and automatic payments would be a significant pain, so you stick with your current bank even if another offers slightly better terms. This is a powerful moat for businesses from enterprise software providers to asset managers. Third, the network effect. This occurs when a product or service becomes more valuable as more people use it. A social media platform like Facebook is a classic example. The value is not in the technology but in the fact that all your friends are already there. Credit card networks like Visa and MasterCard also benefit from a powerful network effect between merchants and cardholders. Fourth, cost advantages. This is the ability to produce a product or service at a lower cost than competitors, allowing the company to either undercut rivals on price or earn higher profit margins. This can come from superior processes, like Geico's direct-to-consumer insurance model, or from economies of scale, like Walmart's massive purchasing power. Fifth, efficient scale. This applies to markets that can only profitably support one or a very small number of players. A railroad or a pipeline serving a particular region is a good example. Once the infrastructure is built, it would be economically irrational for a competitor to build a second one right next to it. After identifying a moat, the final and most crucial step is to ask, is this moat getting wider or narrower? A great business is one that is constantly strengthening its competitive advantages. The antithesis of investing in a moated business is putting your capital into what can be called a no-moat commodity business. This is the path taken by the vast majority of investors who are chasing growth without considering its quality. A no-moat business is one that competes almost entirely on price. Think of a generic airline, a basic restaurant in a crowded food court, a simple steel manufacturer, or a small-scale farmer. These businesses have no durable competitive advantage. The airline's customers will switch to a rival for a $10 difference in fare. The restaurant's patrons will go next door for a lunch special. The steel manufacturer's buyers will choose whichever supplier has the lowest price per ton. These companies live and die by the whims of the market. They have no pricing power. In good economic times, they might eke out a small profit, but in a downturn, they are brutalized. They are forced to cut prices to maintain volume, their margins evaporate, and they often fall into unprofitability and even bankruptcy. Investing in these no-moat businesses is a difficult and often heartbreaking endeavor. Because there is no sustainable advantage, their fortunes can turn on a dime. They are in a constant state of intense competition, a race to the bottom on price. The common mistake is to see one of these companies when it is trading at a low multiple of its earnings and think it's a bargain. But often, it's a value trap. The low price reflects the market's correct understanding that its current earnings are not sustainable. This is the opposite of the stable businesses Buffett seeks. It is the very definition of a fragile enterprise, a house built on sand, ready to be washed away by the first competitive storm. It's a path that leads to high turnover, constant worry, and ultimately, substandard returns. The direct financial connection between an economic moat and a company's financial statements is clear and quantifiable. It manifests primarily in two key metrics: a consistently high return on invested capital, ROIC, and stable, high profit margins. ROIC measures how efficiently a company is using its capital to generate profits. A company that can consistently generate an ROIC of, say, 20% or more year after year almost certainly has a durable economic moat. It means that for every dollar the company reinvests into its business, it is creating 20 cents of annual profit. This is the hallmark of a great business. A no-moat, commodity-like business, in contrast, will struggle to earn returns that are higher than its cost of capital, often in the single digits. High and stable profit margins, like gross margin and net margin, are another clear indicator of a moat. They demonstrate that the company has pricing power. It can charge a premium for its products or services without losing customers to competitors. When you screen for companies looking for a long history, a decade or more, of high ROIC and stable margins is one of the most effective ways to hunt for moated businesses. This financial signature proves that the competitive advantage is not just a theoretical concept, it is a reality that is generating tangible, superior financial results. This leads to faster compounding of intrinsic value, and over the long term, a much higher stock price. A moat is not just a nice story. It is a fortress that protects a company's ability to generate cash, the ultimate source of all investment returns, and the cornerstone of genuine financial stability. The fourth pillar of this investment philosophy is an active and aggressive avoidance of the future. This sounds counterintuitive. Isn't investing all about the future? Yes, but it is about the knowable future, not the speculative future. This pillar is about the perils of prophecy, the immense folly of trying to predict technological revolutions, and the wisdom of betting on human nature instead of human innovation. While the rest of the world is desperately trying to figure out which new technology will create the next trillion-dollar industry, the Buffett-inspired investor is focused on the industries that will be least affected by any new technology. This is a radical reframing of risk. The greatest risk is not missing out on the next big thing. The greatest risk is betting on the next big thing and being wrong. This pillar is the ultimate defense against the most destructive force in investing: speculation disguised as foresight. It is a commitment to avoiding speculation at all costs. The perfect foundational anecdote for this principle is Buffett's acquisition of the Burlington Northern Santa Fe (BNSF) Railroad in 2009. A deal so large it was described as an all-in bet on the economic future of the United States. At the time, in the depths of the Great Recession, the financial world was obsessed with recovery plays, new technologies, and complex financial instruments. Buffett, instead, used tens of billions of dollars to buy a 19th-century technology, putting goods on steel wheels and rolling them across the country. It was the epitome of an old economy investment. Why? Because the railroad represents the pinnacle of predictable, anti-prophetic investing. Buffett didn't need to predict what people would be buying in 20 years. He didn't need to know whether they would order from Amazon or shop at Walmart. He didn't need to guess which brand of car they would drive or which smartphone they would use. All he needed to be right about was that as long as the American economy grew, people and businesses would need to move more stuff from point A to point B. The railroad is the circulatory system of the economy. It is a bet on aggregate economic activity, not on any single product or technology. It is a technologically agnostic investment. Furthermore, the railroad industry has an immense economic moat due to efficient scale. It is virtually impossible for a new competitor to acquire the land and lay the track to compete with an established player like BNSF. This combination of being essential to the economy and protected by an insurmountable moat makes its future, while tied to the economic cycle, remarkably predictable over the long term. The purchase of BNSF was a powerful statement. While others were trying to be prophets of the new, Buffett was content to be a partner in the inevitable. It was a masterstroke of long-term investing, a decision to own a piece of the bedrock of the economy rather than speculate on the shifting sands of technological change. The psychological trap that this pillar helps us to avoid is the potent combination of the availability heuristic and recency bias. The availability heuristic is a mental shortcut where we rely on immediate examples that come to mind when evaluating a specific topic. Because the news is constantly filled with stories about breakthrough technologies, artificial intelligence, and disruptive startups, these concepts are highly available in our minds. We therefore tend to overestimate their importance and their viability as investments. We hear about the one startup that became a giant, and we forget the 10,000 that went bankrupt. Recency bias is the tendency to give greater importance to more recent events. A tech stock that has gone up 500% in the last year feels like a more compelling investment than a stable utility that has grown at 8% per year for the last 30 years. The recent, dramatic performance captures our attention and hijacks our decision-making process. These biases create a powerful pull towards speculative, high-risk investments. They make us feel that if we are not invested in the future, we are being left behind. Buffett's approach is a conscious and deliberate rejection of these mental shortcuts. He actively downplays the importance of what is new and exciting, and instead focuses on what is old and durable. He is essentially saying that the most valuable information is not in today's headlines but in a century of economic history. By forcing himself to ignore the siren song of the new, he insulates his decision-making from the emotional volatility created by the availability heuristic and recency bias. This allows him to maintain a rational, long-term perspective, which is the scarcest and most valuable commodity in the financial markets. To put this into practice, one can use the technological agnostic blueprint for investment selection. This model steers you toward businesses that will thrive regardless of which specific technologies win or lose. The first step is to identify a fundamental, unchanging human need or desire. Think of categories like shelter, food, transportation of goods, entertainment, or the desire for social status. These needs are timeless. The second step is to find the businesses that serve that need in the most durable, low-cost, and essential way. These are often the picks and shovels of the economy, a reference to the gold rush, where the people who made the most consistent money were not the prospectors, but those who sold them picks, shovels, and blue jeans. For example, instead of trying to pick which new electric vehicle company will win, you could invest in the utility company that will sell electricity to all of them. Instead of trying to pick the winning streaming service, you could invest in the company that owns the content library that all services will need to license. The third step is to ask the critical question: does this business benefit from overall economic progress without being tied to a specific technological outcome? BNSF is the perfect example. It benefits if the economy grows, period. An insurance company benefits as people acquire more assets to insure, regardless of what those assets are. A beverage company benefits as global standards of living rise, allowing more people to afford simple luxuries. This blueprint is a powerful tool for avoiding speculation. It forces you to invest in the underlying currents of the economy rather than trying to surf the chaotic and unpredictable waves of technological innovation. It is a core component of a sound investment strategy focused on capital preservation and predictable growth. The antithesis of this approach is the venture capitalist wannabe. This is the retail investor who treats the public stock market like a venture capital fund. They are not looking for stable, profitable businesses. They are exclusively hunting for 10 baggers, stocks that they hope will increase tenfold. Their portfolio is filled with money-losing biotech startups, unproven software companies, and other speculative ventures. They are essentially buying lottery tickets. This mindset is fundamentally flawed for several reasons. First, true venture capital is a highly specialized field. Professionals in that industry have deep domain expertise, conduct months of due diligence, take board seats, and actively guide the companies they invest in. A retail investor buying a few shares on an app has none of these advantages. Second, the failure rate in venture capital is astronomical. For every one massive success, there are dozens of complete failures. A professional VC fund can absorb these losses because their one winner pays for all the losers. A retail investor's portfolio can be permanently crippled by just one or two of these speculative bets blowing up. This approach is driven by a narrative-first, numbers-second mentality. The investor falls in love with a story, a visionary CEO, a world-changing technology, and ignores the brutal business realities, such as a lack of profits, massive cash burn, and intense competition. It is the absolute definition of speculation, not investment. It's a path characterized by extreme volatility, emotional decision-making, and, for the vast majority who attempt it, the systematic destruction of capital. The direct financial connection of this anti-prophecy stance is rooted in the mathematics of ruin. The most important principle for long-term wealth accumulation is avoiding the zero, an investment that results in a total loss of capital. Let's consider the numbers. If you have a $10,000 portfolio and one of your $2,000 investments goes to zero, you have lost 20% of your total capital. You now need to achieve a 25% gain on your remaining $8,000 just to get back to where you started. A single catastrophic loss creates an enormous headwind against the power of compounding. The technological agnostic approach is, at its core, a strategy for minimizing the probability of ever investing in a company that goes to zero. A railroad like BNSF, an insurer like Geico, or a consumer staple giant like Procter & Gamble have a near zero probability of going bankrupt. Their business models are too robust, their market positions too entrenched. By populating your portfolio with these types of durable, predictable enterprises, you are engaging in the highest form of risk management. You are protecting your capital from the risk of permanent impairment. This dramatically improves the odds of successful long-term compounding. The financial advantage is not in the spectacular short-term gains you might occasionally see in speculative stocks. It is in the relentless, uninterrupted upward march of your capital base over decades, shielded from the devastating setbacks that plague those who gamble on the unknowable future. This is the mathematical soul of capital preservation and the secret to building lasting financial stability. The fifth and final pillar is the ultimate objective, the prime directive that governs all other principles, the preservation of capital. This is the idea that the first goal of any investment operation should not be to make money but to not lose money. This may sound defensive or overly conservative, but it is the most aggressive and powerful long-term wealth-building strategy there is. It is encapsulated in Buffett's two famous rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is not a suggestion to avoid all risk and hide your money under a mattress. It is a philosophy that reorients the entire investment process. It dictates that every decision must first be filtered through a lens of downside protection. Before you ask, "How much can I make?" you must first ask and answer with brutal honesty, "How much can I lose?" This pillar is the culmination of all the others. A predictable business, inside your circle of competence, with a durable economic moat and an industry that is not subject to rapid technological change, is the ultimate vehicle for capital preservation. The foundational anecdote for this pillar is, fittingly, a story of failure. It is the story of the original Berkshire Hathaway, the failing New England textile mill that Buffett bought in the 1960s. This was a classic cigar butt investment, straight from the playbook of his mentor, Ben Graham. The company was trading for far less than its working capital, meaning he was getting the physical plant and equipment for free. It was statistically, undeniably cheap, but it was a terrible business. The American textile industry was in terminal decline, facing overwhelming competition from low-cost foreign producers. For the next 20 years, Buffett struggled with the business. He poured millions of dollars of good money from his other investments into Berkshire's textile operations, trying to keep it afloat, trying to turn it around. It was, in his own words, like pouring water into a leaky bucket. The business was a constant drain on his time, energy, and capital. Eventually, in 1985, he had to shut down the textile operations for good. This painful, 2-decade-long experience taught him one of the most important lessons of his career. He learned that it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. The cheapness of the textile mill was an illusion, because the underlying business was so bad that it was destined to destroy capital over the long run, not create it. This failure seared the principle of capital preservation into his soul. He realized that the initial purchase price is only part of the equation. The quality of the business is the ultimate determinant of whether you will preserve and grow your capital. The ghost of the Berkshire textile mill is what drives him to seek out predictable, moated businesses like See's Candies and Coca-Cola. It was a multi-million-dollar lesson that taught him that avoiding a bad business is just as important, if not more important, than picking a good one. The psychological principle that makes capital preservation so critical is loss aversion. Decades of research in behavioral economics, most notably by psychologists Daniel Kahneman and Amos Tversky, have shown that for most people, the psychological pain of losing is approximately twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. This deep-seated evolutionary bias has profound implications for investors. It is the reason why people panic and sell at the bottom of a market crash. The pain of seeing their portfolio value decline becomes so overwhelming that they make an irrational decision to sell at the worst possible moment, just to make the pain stop. Buffett's entire philosophy is engineered to be compatible with this fundamental aspect of human psychology. By making never lose money the primary rule, he is building a system designed to minimize the chances of ever having to experience that intense psychological pain of a large loss. A portfolio of stable, predictable businesses will be less volatile than the broader market. It will decline less during panics. This emotional stability is a massive strategic advantage. It allows the investor to remain rational when others are fearful, to stick with their long-term plan, and even to deploy capital when opportunities are most attractive. By prioritizing capital preservation, you are not just protecting your finances, you are protecting your mind from the destructive panic that loss aversion can trigger. You are aligning your investment strategy with your own psychological wiring, creating a sustainable path to financial freedom that you can actually stick with through good times and bad. To implement this principle, you can use a powerful applied mental model known as the pre-mortem analysis. This technique, popularized by psychologist Gary Klein, is a potent tool for risk management. Here is the blueprint for how an investor can use it. Before you make a final decision to buy a stock, you must conduct its funeral. Imagine that it is 1 year from now, and the investment has been an unmitigated disaster. The stock is down 50%, and your thesis is in ruins. Now, take out a piece of paper and write a detailed story explaining exactly what happened. Why did it fail so spectacularly? Was it a new, disruptive competitor that came out of nowhere? Was it a change in consumer tastes that made the company's product obsolete? Was it a regulatory change that crippled its profitability? Was there a scandal in the executive suite? Force yourself to come up with 2 or 3 plausible, detailed narratives for this failure. This exercise does 2 critical things. First, it forces you to confront the potential risks of the investment in a very concrete and visceral way, counteracting the natural optimism and confirmation bias that often surrounds a new investment idea. Second, the ease or difficulty with which you can write these failure stories is a powerful indicator of the business's predictability. If you can instantly come up with 5 different highly plausible ways the business could be destroyed in the next year, it is clearly not a predictable, durable enterprise. It fails the test. If, on the other hand, you struggle to create even one believable story of its demise, you have likely found a business with a very strong moat and a high degree of predictability. The pre-mortem is the ultimate capital preservation tool because it forces you to focus entirely on the downside before you ever commit a single dollar. The antithesis of capital preservation is the high-risk, high-reward mantra. This is the philosophy of the gambler, not the investor. It is the path of the 99% who are perpetually focused on the potential upside of an investment while giving little to no thought to the potential downside. They are drawn to stories of explosive growth and overnight riches. Their decision-making process is a post-mortem in reverse. They fantasize about all the ways an investment could succeed, creating elaborate narratives of a glorious future. They look at a speculative stock and think, if this goes up 10x, I'll be rich, without ever stopping to consider the much higher probability that it could go down 90% or to zero. This approach leads to a portfolio constructed of fragile, high-risk bets. It is a portfolio with no margin of safety. When the inevitable market downturn or company-specific problem occurs, these investors are completely unprepared. Their portfolios suffer devastating losses from which it can take years or even decades to recover. They violate rule number 1 constantly, and as a result, they never get to experience the true power of rule number 2. They are stuck in a cycle of chasing returns, getting burned, and starting over, never understanding that the secret to getting rich slowly is to first and foremost avoid getting poor quickly. This focus on offense at the expense of defense is the single most common and destructive mistake in the entire field of personal finance. The ultimate direct financial connection of the capital preservation pillar is the inviolable mathematics of compounding. Albert Einstein supposedly called compound interest the 8th wonder of the world. And for good reason. It is the engine that builds all great fortunes. However, this engine has one critical vulnerability: large losses. The math is simple, but brutal. If you suffer a 10% loss, you need an 11% gain to get back to even. If you suffer a 25% loss, you need a 33% gain. If you suffer a 50% loss, you need a 100% gain, a doubling of your remaining capital just to get back to where you started. A single large loss can set you back for years and wipe out the gains from many successful investments. A strategy focused on capital preservation is designed to avoid these devastating setbacks. Consider 2 investors over 20 years. Investor A pursues a high-risk, high-reward strategy, achieving some spectacular gains but also suffering large losses. Their annual returns might look like plus 40%, minus 30%, plus 50%, minus 40%. Investor B focuses on capital preservation, investing in stable, moated businesses. Their returns are more modest and consistent, plus 10%, plus 8%, plus 12%, minus 5% in a bad year. At the end of the 20-year period, Investor B's portfolio will be worth vastly more than Investor A's. The steady, uninterrupted compounding, shielded from catastrophic declines, is mathematically superior. The direct financial benefit of prioritizing capital preservation is that you maximize the efficiency of your long-term compounding machine. It is the quiet, unglamorous, but mathematically certain path to building significant and lasting wealth. It is the final promise that a disciplined process makes to the patient investor. You have just been handed the keys to the kingdom of predictability. You've been given a blueprint for seeing the world of business not as a chaotic casino of speculation, but as an ecosystem of enterprises that can be understood, analyzed, and valued. This mental model, the rearview mirror test, is the framework Warren Buffett has used to insulate his fortune from the madness of crowds and the euphoria of bubbles. It is a powerful tool for risk management, a system for identifying businesses built on the bedrock of human habit rather than the shifting sands of technological fancy. You now possess the first and most foundational piece of the puzzle. But understanding what to look for, a predictable, moated business inside your circle of competence, is only one half of the equation. The second, and arguably more critical, part of the process is knowing when to buy it. A great business is not a great investment if you pay too high a price. Predictability tells you a business is good, but it doesn't tell you if it's cheap. Buffett's genius is not just in identifying wonderful companies, It is in his ironclad, almost inhuman discipline to only buy them at a price that offers a significant margin of safety, a deep discount to their intrinsic value. That discipline, that framework for valuation and for understanding price versus value, is the missing link. It connects the fortress of a great business to the timing of a great investment. It is the bridge from being a brilliant analyst of companies to being a successful allocator of capital. The video that is now on your screen has been designed to be that next piece of the map. It's engineered to deliver the other half of the strategy, the operational tactics that turn brilliant insights into tangible profits. The choice to click is not about watching another video. It's a declaration. It is a choice to move from being a student of the theory to a master of the practice. It is a commitment to complete the mental arsenal you have started building today and to transform, forever, how you deploy your money into the world. The journey to financial sovereignty continues, and the next step is just one single click away.